Hey everyone, welcome back to The Profit. My name is Isaiah Bell. Today we're going to look at more questions covering the SIE and Series 6 exam, right? If you've seen one of my videos before, remember that the SIE and the Series 6 exam are very, very similar in nature. It's pretty much the same questions, same test topics. They just ask questions in different ways. But again, if you understand uh, the basics, if you understand the foundations, if you understand how these products and accounts work, it really doesn't matter how they ask you the question, you should still get it right. All right, so keep in mind, as you're going through the questions, feel free to pause the video and try to answer the question on your own before I give the answer. But I will try to break it down as best I can. So starting with number one, the cost basis of a mutual fund shares includes the cost basis of a mutual fund shares include. All right. So when we're talking about cost basis, we're talking about, I'm just going to use the word input, what the investor put in, right? What the investor put in. So A, the total cost, including sales charge plus dividends or capital gains reinvested in the fund. B, the total cost excluding sales charges plus dividends minus capital gains reinvested in the fund. C, the total cost including sales charge plus any dividends or capital gains received in cash. D, the total cost excluding sales charge plus dividends or capital gains reinvested in the fund. So this question I went through with a few people. I want to say the number one answer that I get is C. Or maybe is it B? Oh, no one else I get is B, I believe. So I think I'm just gonna go ahead and just give you the correct answer instead of trying to break down each one. The correct answer is going to be A. And why is it A? It's A because when we look at cost basis, we're looking at what has been input, but we're also looking at what's been spent. Right? So sales charge. So if let's say you're buying a mutual fund, this mutual fund is $20. All right. Sales charge, sales charge may be an additional 5%. So we're just gonna say plus 5%. All right. You spent that, right? That's what you spent initially. It's not your principal, but the sales charge it does cost you. It can be you can say it can be $20 plus 5%, but they usually take the 5% out of $20. So you figure out what's 5% of $20 is probably just $1. 10% of $20 is $2, so 5% is going to be $1. So you're going to invest 19, but you still spent $20. All right. So the sales charge is included in that total cost for you to get in. Dividends and capital gains is what the company issues. Capital gains in a mutual fund, you do capital gains to a mutual fund too, because the mutual fund invests in other securities. So the company is going to issue those dividends and capital gains. And then and then here it's saying is reinvested. Reinvested means that the money, you never actually see the money. The money never actually hit your account. Typically, when people are saving, if you have a savings account and you get paid weekly or monthly, people say they don't, it's money that goes to saving, they don't count it as income. They say, well, I never see it, so it doesn't really matter to me because I never see it. And they kind of look at that when it comes to dividends and capital gains, because it reinvests, they say they never see it. But government does not look at it like that. That's not how the government sees it. The government sees it as the company, the investment company, paid you dividends, paid you capital gains. Doesn't really matter if you took it in cash. Clear the screen. Doesn't matter if you took it in cash or you reinvested it. The government look at it as a taxable event. All right, they look at it as a taxable event. You received it. For this question, because you're still putting money in, this is still your money. The company paid it to you, but it's your money. You just on the application somewhere you check the box to reinvest it. Right, it's still your money, so this is still adding to the total cost. It's still adding to your cost basis. Right, so the correct answer here is going to be A. Right. Next question, number 2. Let's scroll up some. Which of the following statements are true of mutual fund dividend distribution? All right, I think I kind of answered this question in question 1. So 1, the fund pays dividends for net investment income. 2, an individual taxpayer may exclude $100 worth of dividend income from taxes annually. 3, an investor with liable taxable distribution, whether taken in cash or reinvested in the fund. 4, an investor is not liable for tax if he automatically reinvests distribution. All right. Typically for these questions, I like to choose one that is wrong and one that is correct, one that is wrong, and one that is correct. So let's say I say, because I kind of answered number 2 and number 1. Remember I said that anytime you receive dividends or capital gains, distribution, the government sees that as a taxable event. They don't care if you take it in cash or reinvest it. And if you look at number 3, it says it's taken in cash or reinvested. You're liable for those taxes. So we're going to say 3 is correct, and we're just going to say 4 is wrong. Right? And so then I'm looking at my answer choices, and I'm going to cross out all the ones that got 4 in it. And then I'm just looking for the last one that got 3 in it. And I come up with 1 and 3. All right? I know 4 is wrong. I'm saying 4 is wrong because 3 are right. They kind of contradict each other. They contradict each other. So I gotta pick one. They both can't be right because they contradict each other. So I'm saying 3 is correct, and I'm saying 4 is wrong. I crossed all the ones that got 4 in it, and then there's only one left that has 3 in it. So that automatically says or implies that 1 is correct. And as I'm looking at 1, the fund paid dividends from net investment income, that is correct. So after everything, net investment income, so I think, everything has pretty much been paid. Expenses, everybody's got paid. Taxes have been paid, and they start issuing dividends out. They issue that from net income, net investment income. All right, 2 sound like a law. An individual taxpayer may exclude $100 worth. That sounds like a law for the IRS maybe wrote, and that's just not true. So 1 and 3 is the correct answer here. 3. A young, recently married couple would like to purchase a home within 5 years. They have $2,000 in savings and $400 a month to invest. In addition, they owe $35,000 on student loan to be repaid over the next 10 years. What type of mutual fund investment would likely be the best recommendation? All right, so you have a young, recently married couple. They want to purchase a home within the next 5 years. All right, they have $2,000 savings and they invest $400 a month. $400 a month was 4 times 12, 48. So they saving about $4,800 a year. In addition, they owe $35,000 in student loan debt to be repaid over the next 10 years. What is the best investment that you would recommend to this couple? So you, as the now licensed broker, you have to make a recommendation. A, build up cash reserves, then save for a down payment on the new home. Investing must wait. B, pay down the student loan, invest $200 a month in the value fund for purchase of a new home. C, invest $2,000 in a real estate investment trust for the home purchase and use $400 per month to pay down the student loans. D, dollar cost average, $400 per month in an asset allocation fund, lowering the average cost per share of the investment. Now, I've been giving this question to a few people. Well, I always get this question to people. I always get this question to people. Because you want to know the mind state they're in. So the SEC, FINRA, does not care whether or not you as the broker make money. What they care is that you do the best thing for the client. All right. So typically, when I get this question to people always choose between B, C, or D. They're definitely going to choose between B, C, or D. They're going to automatically take A. All right. I even had one person says, well, I know it can't be A because A don't make me no money. And, I say, yep, that's exactly true. A does not make you any money. All right. So, we're focusing on B, C, and D. A doesn't make me any money. All right. And again, the SEC and FINRA does not care if you make money or not. What they care is that you do the best thing for the client. And when I tell people that the correct answer is, well, I know I remember telling one person that the correct answer is A, and their question was, well, how is it A? A doesn't make me any money. I'm trying to drill that into them. For test taking purposes, we're not looking what makes you money. We're looking for what's the best thing for the client. Right. And so there's kind of a unwritten rule. I'm not going to say you're going to find it in your whatever textbook you're reading, but if you Google or if you listen to some fund managers or money managers on YouTube, they would definitely tell you pay off your debt before you start investing. All right. So paying down the student loan, investing at the same time, no. Investing $2,000 a month, invest $2,000 real estate trust for the home purchase and $400 a month to pay down the student loan, no. And using dollar cost averaging, no. You got student loan, you want to buy a home. You need to build up the cash reserves, pay down the debt, and invest in must wait. A is the correct answer. Right? And the thing is, this is your livelihood. This is how you make money. This is how you're going to feed your family. For test taking purposes, do what's best for the client and the best thing for the client. And usually how I get people to answer this question correctly. So I have to say, say if you never heard me say anything I just heard, and you say C. And I would say, okay, C, okay, cool. All right, C is a good answer. I haven't already told you A was the correct answer. Because normally, I'm speaking as if I'm not in front of somebody. Well, I'm not in front of somebody right now. So if I'm sitting in front of somebody and they tell me C, I say good. C is a good answer. Now, imagine if I'm your daughter or I'm your son sitting across from you getting this advice. What would you tell me to do if I was your child? If I was your family member? Well, no, let's just say if I was your child, because people will sometimes rip off their family members too. All right, so let's imagine if I was your child and I came to you looking for advice on what I should do, what would you choose then? Automatically, they give me A. Initially, they would have gave me B, C, or D. But if not explaining anything, not going through anything, and I asked them, what answer would you pick if I was your child? They said, oh, I'll choose A. So you do understand. They do understand, what they're doing subconsciously. They do understand. It's just for somebody else, let's make a check. But when it came to your own offsprings, you say, okay, you should do this. This is the better option. You need to wait on the best. And that's all the SEC and FINRA want you to do the same thing. Just picture it's your kids. And then it's aha moment. Say, oh, okay, I get it now. Okay, yeah, that's all y'all do. Picture your kids. All right, so moving on. 4, rank the following from least to most capital risk. Rank the following from least to most capital risk. So we got We got Ginnie Mae, GNMA, that's Ginnie Mae. We have a treasury bill, adjustable preferred stock, and zero coupon bonds. All right. Ginnie Mae is not a federal security, but it is backed by the feds. Backed by the feds. Right? It's backed by the federal government. It's not a federal security, but it's the one debt security that is backed by the federal government. Just only one. Treasury, that is federal. Preferred stock, that's corporate, and zero coupon bond is also federal. All right, zero coupon bonds mean doesn't come with coupon. Usually bought for education purposes. So they want you to rank them from least to most capital. Now I wrote them. I wanted you to know which ones were Fed and which ones were corporate, so you can kind of get an idea of how you can put these in order, right? T-bill is going to have the least amount of risk. So I'm going to say the T-bill goes first. So we should automatically cross out B and C because the T-bill goes first, right? And then the preferred stock, because it's equity, it's going to have the most amount of risk, and that should go last. So I'm looking at D now. Right? 2 is first, 3 is last. The 2 fall, they fall. And they definitely fell in the right place. Treasury bills, it kind of goes in this order, basically. Kind of goes this way. Right? Treasury bill is going to be the least amount of risk, followed by Ginnie Mae, then the zero coupon bond, then the preferred stock. That's the way it's going to go. Right? Not much to explain. They just kind of got to see it. 5. Your 70-year-old client with $400,000 wishes to assemble a portfolio that would provide her with a consistent cash flow for a projected life expectancy. She would like to maximize her return, but is not willing to assume a high degree of risk. Which of the following securities might you suggest for this portfolio? All right, so she's 70 years old. All right, so she's up in age. 400,000. She wants consistent cash flow for a projected life expectancy. She wants to maximize her return, but is not willing to assume a high degree of risk. Cool, then we got everything. And we really need to focus on cash flow and risk. Cash flow and risk. We want to keep the cash flow consistent, and we want to maximize on risk. Those are the 2 things. Even if we took the age out, we still want to focus on cash flow, high degree of risk. She don't want risk. So 1, we have an ABC Corporation debenture, SP rating AAA. 2, we have an XYZ Railroad Equipment Trust Certificate, AA rating. 3, we have an MNO Corporation Convertible Bond, AAA rating. And 4, we have a DEF Corporation Common Stock. Can't tell you which one I normally get. Answers I normally get for this question. I can tell you people normally cross out 1. Why do they normally cross out 1? Because they see the word debenture. For some reason, the word debenture just carries some type of negative connotation with it. Like for some reason, it just sounds negative. I don't know why. But a debenture is just simply a type of debt. That's all it is. It's to say it another way, it's just unsecured debt. Really no different you having a credit card. Right? It's an unsecured, when they give you a credit card and you go swipe it, it's an unsecured promise that you're going to pay them back. They're going off your credit rating. All right. So you're looking at the liquidation order. It's wages. indemnity, taxes, general creditors, secured, then unsecured, secured and unsecured, secured. You can say secured debenture. Well, no, you can't say secured debenture, but unsecured is the debenture. Then you have subordinated debenture. You know, the debenture and the subordinated debenture are just literally the same, just one came before the other. So you have secured debt, and you have secured debt, and the unsecured debt is just a debenture. So they automatically throw out one out. 2, railroad equipment trust certificate. The railroad equipment trust certificate 2, that is secured. The corporate convertible bond, all right, the corporate convertible bond. This, she's not, if I buy a convertible bond, this means I'm looking to own common stock, right? In the investment world, when you learn for testing purpose, common stocks looks to be risky. She doesn't want risk. There's no reason for her to buy the convertible bond. One, if I buy the convertible bond, this means that I'm going to be issued a lower coupon payment, right? Because this is a special feature, and because I'm getting this special feature to own the common stocks, they're going to pay me a lower payment. She wants to maximize her return, right? We're not looking to own common stocks. We're looking to maximize return. This is not maximizing return because the fact that I'm having a chance to convert to common stocks, that lowers my payment. And just because I own common stocks, that does not, let's see, I'm bad with spelling. Yeah, I'm really bad with spelling. Guaranteed dividends. Just know I was trying to spell guarantee, but that's not guaranteed dividends. All right. So common stocks, just because you own common stock does not mean that you're going to get a dividend. So really 3 and 4 both out. The debenture, again, is unsecured debt. It has AAA ratings. Because it has that good credit rating, you know, that puts her at ease with the risk. This is gonna pay every 6 months, so that's gonna be a consistent cash flow. And the railroad trips equipment trust, also the same thing. It takes down the risk because it's secured, has a AA rating, maximize the cash flow, and it also has a maximize the return, and also has a consistent cash flow. So A will be the correct answer here, right? So you kind of dissect those things. Then common stocks pays dividend is not guaranteed. She's not looking to own common stocks because she doesn't want risk. So she doesn't need to buy anything that puts her in a position to own common stocks and gives her lower payments. Right? So again, 8, 1, and 2. 8, 1, and 2. Those are our questions. We could have looked at it another way. Kind of did a question earlier. I could have said 1 was correct, 3 was wrong. So I came through and crossed all the ones out that had 3 in it, looked at the only one that had 1 in it, and led me to A. That's probably exactly how I would have did it. Right. Hopefully you enjoyed that. Please like and share. If you did like the video, please like and share the video, write a review, let me know how I did. In the description of this video or below, you'll see a link for a course on Udemy. If you are studying for the SIE or the Series 6 exam, you can purchase my course on Udemy to help get prepared for that. The video is about 55 videos, and it's pretty much very, very, very thorough. Do the same thing here, go through each chapter, and I go through some questions at the end of each chapter to, help you build test taking confidence and get you prepared for the exam. So please check out the link and go purchase the course. If you need additional help, just reach out. Hopefully you enjoyed this video. Again, like and subscribe if you actually did. Other than that, have a good day. Thank you.